Good morning, everybody. It is Friday, the 19th of June. It is a federal holiday, but I am working today and making sure I'm here to take great care of you. Took last Friday off. I was on vacation with my family, enjoyed a nice trip to New England, and now we are back and at it and ready to take great care of you. So first and foremost, a lot has happened over the last week, and I really want to dive in and help you understand what is happening. So the biggest story right now is, again, mortgage rates. I have been saying since February that the big shift in mortgage rates is going to be driven based on inflation, which is coming from the rise in oil prices, which is coming from the issues that are happening in Iran. Well, guess what? Over the last week, we made some serious progress in that. Oil prices have come down. So that's been really, really, really good because we've seen oil prices come down. That's brought down the U.S. Treasury, the 10-year Treasury, which is basically just a bond. It's a loan that the federal government is perpetually giving that you can buy into that loan, and it's called a Treasury bond. And the rate of Treasury bonds drives a lot of other interest rates, especially mortgage rates are tied to Treasury bonds. And so that's been moving down, and that's been really, really good. And then this Wednesday, 2 days ago, we had the first meeting of the Federal Reserve with the new chairman. So the new chairman is Kevin Warsh. He is now in charge. But the problem is that he doesn't get to make a lot of decisions. He's really the figurehead. He's the committee chairperson, but he's not the decision maker. And I've been telling you that we've had some big shifts in expectations from the Fed. With Trump saying, hey, I want Kevin Warsh to lower interest rates. People are expecting the Fed's are going to lower interest rates. But the Fed has an obligation to watch the markets and to decide where the markets are going. And it's not one person making that decision. And that division has been getting bigger and bigger. And here's what happened Wednesday. You had the new Federal Reserve Chairman, Kevin Warsh, come out and say, look, I don't really want to be very transparent with you guys anymore. I don't think it's a good idea for me to share with you what we're thinking. I think we should do that without sharing it with you like they used to back in the good old days, which is kind of freaking out the markets. On top of that, Warsh came out and said, look, here's our projections for where we think interest rates are going. And that's not his number. That's the number for all of the Fed chair people, and more of them, almost half of the Fed chair people expected a rate hike this year. Yes, they're the ones that are in charge of rate hikes. Now, please do not misunderstand. Rates do not move when the Fed changes rates, but the Fed influences the market. And as a matter of fact, what the Fed is saying right now is influencing the market, because every time they meet, they put a chart out saying, hey, going over the next 2 years and beyond, where do each of us see interest rates being? And it's not the number that they think, but the change. And so between last meeting and this meeting, more of them are saying, hey, I think we're going to see higher interest rates before the end of the year. They're the ones that vote on what the rate is going to be. Now, they don't vote on mortgage rates. Don't confuse that. But the Federal Reserve votes on what their rate is going to be. And those people who do the voting have told us they expect, more than half of them now expect rates to be higher at the end of the year than now. Why? Because there's an issue overall with inflation, even if oil prices are coming down, even if the issue in Iran is solved. We've got employment that is staying strong and inflation that is staying high. And those are the two things the Fed's in charge of. They're in charge of keeping inflation low and employment high. Well, they have employment high, and all the concerns about AI causing job losses aren't coming true yet. Whether they do or not is yet to be seen, but we're not seeing a significant amount of job losses. And the truth is, AI is making businesses more efficient. And that's actually making, another piece the Fed has to look at in this whole thing. I'm not going to go into all of those details. The bottom line that I'll tell you is right now we're seeing relief on the oil side of things, but we're seeing more pressure from the Fed side of things, which means we're not seeing rates dropping like we would like to see. And that sucks because we went from one problem to another problem. And so rates are going to stay volatile. We're going to see interest rates, in my opinion, in the low to mid sixes for the foreseeable future, especially as the Fed says they see themselves raising interest rates before the end of the year because inflation just is not going away. And this is a major problem that the Fed has to get under control, is inflation, or it becomes an even bigger issue than we saw back in 2022 and 2023. Here's the good news about the housing market. Demand is still holding up. So we're seeing the number of houses coming on the market, the number of buyers that are wanting to buy. Demand is there from the buyer's side, but what we're seeing is really tight inventory. What does tight inventory mean? It means that, first of all, this is a national statistic, and I'm talking to people all across the country, but it's all about what's in your neighborhood. So don't confuse what I'm saying about what's happening in your neighborhood. Nationally, we see tight inventory overall. That means that it's not necessarily a seller's market or a buyer's market. I think in some markets, buyers have a lot of leverage. But I think in a lot of markets, buyers think they have a lot of leverage that they don't have. And I was just talking to a realtor yesterday about a seller that I have done a lot of business for. And that seller, and I connected that seller with this realtor. And the buyer was trying to overplay their hands. The buyer was trying to strong arm the seller into giving him much, much bigger credit. And I was talking to the seller's agent, and I'm like, I don't think you give in. I think you stand firm, and she agreed. And so my point is, inventory is tight. We don't have as much leverage as we think we do as buyers. And so don't mistake the media and what you're reading and saying, oh my gosh, everything is so hard for sellers and buyers have the opportunity and the leg up right now. That isn't always the case. Okay. But here's the deal. The reason partially for this is because sellers feel stuck. So do buyers. Sellers feel stuck because sellers have super low interest rates. Now, nationally, again, that statistic is dropping, meaning the statistic regarding how many people have low rates that are unwilling to sell or move or refinance because of their low rates is getting a smaller and smaller and smaller portion of the population, of the market. Why? Because people have to move. And so somebody that has a 2.5% interest rate can't just keep that forever if they want to, because maybe the house is just too big. Maybe there's an issue with a job location and they have to relocate. People are moving and they're giving up those low rates because they have to, but there's still a lot of them that would like to move, but they just won't because they have a super low interest rate. And so we've got people feeling stuck, and that is causing buyers to feel stuck and buyers to feel like, I don't know, with rates being so volatile, I'm not sure if I want to commit to writing an offer on a home because I don't know where the rate's going to be tomorrow when I want to lock in my interest rate, because you can't lock until you get your offer accepted. And so that creates a lot of people feeling stuck right now, which is why inventory kind of feels tight, because there's enough buyers for the amount of sellers and there's enough sellers for the amount of buyers, but there isn't a normal amount of activity happening because everybody kind of feels stuck. And speaking of feeling stuck, I want to pivot for a quick minute and talk about part of that stuckness is our parents and our grandparents not wanting to sell their house. They want to age in place. That's a big thing that's happening right now, is people talking about aging in place. And the thing about aging in place partially is happening because the cost of long-term care is super expensive. Too few people purchase long-term care insurance. That's super expensive to purchase. And so you're saying, hey, I now need to look at paying for an independent care or assisted living or memory care facility, and the expenses are really, really high. And so instead of selling their house and going into those places, they're saying, you know what, I'd rather just stay where I raised my kids. And so they want to age in place. The problem is the average home is getting old. The average home in the United States is very old. But we had a great trip through New England over the last week, and we saw some beautiful homes, but I was thinking to myself, man, I wonder what the conditions are of these homes that, some of them are hundreds of years old. But most of them, in the last 100 years have been built, and the condition in some of them is very, very run down. And so you've got people who are aging in place in homes that are not in good shape. And so there's two things I want to talk about that apply to everybody, not just those aging in place, but I want to talk about, first of all, renovation financing. So renovation loans are absolutely amazing because they give you the ability to purchase a home or refinance a home and include the cost of the renovation in the loan amount. And I base the loan on what the house is worth after the work is done. After the work is done. I have a client right now doing a renovation HELOC. He wants to add an ADU to his house and do some other upgrades to his home. And so we're getting an appraisal done based upon what the home value is going to be worth after they put the ADU on the home, which is going to raise the value of the home. He's spending a couple $100,000 on all the work that he's doing. But now he gets a better interest rate because he's borrowing a smaller percentage of that future value versus a high percentage of the current value. So renovation loans give us the ability to do a loan based upon what the house is going to be worth when the work is done. And don't think this only applies to refinancing, because it applies to purchases as well. If you're in a position where you have at least 5% of your own money for a down payment, you can buy a house that isn't the perfect home, but it is in the perfect location. Can't put down payment assistance with it, but you can buy the house and bundle in the cost of renovation. You just can't do the work yourself. And then you get the contractor to do the work after you become the homeowner, but you only had to put 5% down on the total between the purchase price and the cost of renovation. Instead, most people think, well, I can't do that because I've got to put 5% down on this $500,000 home. So that's gonna be 25 grand plus closing costs. I don't have another 100 grand on top of that for renovations. But what we do is we treat it like a $600,000 transaction. And so instead of putting $25,000 down, 5% of 500, you're putting 5% down of 600 of the total between the purchase price and the $100,000 renovation cost. And now you're only putting $30,000 down plus closing costs, 5,000 extra, but we gave you a loan amount of an extra 95 grand to pay the contractor to do the renovations of $100,000 worth of work. 5 grand came from your pocket. 95 grand came from ours as part of your additional loan. Renovation loans are very, very underutilized. They're not easy loans. You have a lot of pressure on you to pick very quickly what the scope of work, what the quality of the materials that are going to be used, and what specific things you're going to put into the house. You've got to figure out quickly, because you have to get the home appraised based upon what the house is worth after all that work is done. But for a lot of people, it's a phenomenal way to get work done on a home. If you bought your home anytime in the last 4 years, you've got a high interest rate anyway. You've got a rate in the 6s or 7s, and you don't have a lot of equity because home prices haven't gone up. So a renovation loan may actually be your best bet, because you're sitting here right now saying, man, I bought this house 4 years ago thinking that I could refinance and get a lower rate or add on or move. Well, you can't. Like, you're kind of stuck right now. And I know that feeling, but this renovation loan gives you an opportunity to refinance your property, even though you don't have a lot of equity, but you can base the loan on what the house is worth after the work is done. And if you're buying or refinancing, not only are renovation loans an amazing option, but going back to aging in place, reverse mortgages are an absolutely amazing option for the right person in the right situation. And I have had my eyes opened significantly over the last 3 months working for Cross Country Mortgage on how many different types of reverse mortgages there are compared to what I understood previously. We can do reverse mortgages for people down to 55 years old. You can do it not only to refinance a home, but to purchase a home. So you might have a parent or a grandparent who's in a home that's paid off, and they say, you know what, I need to move somewhere else and buy a home, but I got to keep some of that money out of the house I'm selling in order to live off of it. Great, then get a reverse mortgage on the house that you're buying, and now you still have no monthly payment, and you may even be able to set up a payment where the reverse mortgage pays them every single month. If you currently are living in a home and you're saying, hey, I want my parents or grandparents or myself to be able to age in place and stay here and not have to be stuck with that mortgage payment they're paying right now, a reverse mortgage is a great way to convert that loan into a loan that you're not making a monthly payment on, but it's only under the right circumstances. There's a lot of reasons you shouldn't do it. So be very, very cautious. If you have questions about renovation or reverse mortgages, I definitely want you to reach out to me so that I can help you understand how these programs can work for you. I'll be doing more and more videos about these different programs and helping you understand what your options are. So that's about all I've got for you today. It does not look like I have any questions. So if you have questions, you can post comments onto whatever platform you're watching on right now, or you can reach out to us directly. Our contact information is right above. I appreciate you listening. I really appreciate you sharing. If you found this information useful, please share it on your social networks so that I can find more people like you who want to hear really good information about the mortgage industry and what's happening in the mortgage market. Look forward to catching up with you guys next Friday. If you need anything in between, give me a holler and have an absolutely wonderful weekend. Bye-bye.